Joining us now to discuss is Hazen. She's a portfolio manager and chief market strategist at F.L.Putnam Investment Management. Ellen, thank you for being here. Now let's start with that credit downgrade. Spooky markets a little bit this morning, but if history is any indication, prior U.S. credit downgrades haven't led to structurally higher interest rates, recessions, or sustained equity market declines. So given that, how much weight should investors really place on this latest downgrade? Does it carry any meaningful signal for future market or economic direction?
I think you put your finger right on it, Allie. I think that the downgrade was the third downgrade of those agencies over the last decade plus, right? So we had S&P downgrade originally, then we had Fitch, and now we have Moody. So now it's all three of them have downgraded. But if you look at both the equity market and the fixed income market, they've hardly responded. Why is that? It's because the downgrade was based on information that is widely available. Everyone knows deficit is running at 6.5% to 7% of GDP. Everyone knows that debt to GDP is pretty high and unsustainable. Everybody knows that most of the budget is taken up by Medicare, Medicaid, interest expense, and Social Security, as well as defense. And that if we're going to do that, if we're going to fix the deficit, then we need to address those areas. And certainly the bill that was put forward over the weekend doesn't really give us a lot of confidence. So I think the rating agencies were catching up with what the market already knows. I think the more significant impact or dynamic going on today is that this is in the context of U.S. stocks underperforming international stocks for the last several months, right? And we have seen earnings estimates outside the U.S. go up, while earnings estimates inside the U.S. are going down. And we have seen that economic expectations in terms of GDP for this year and next year are going down here. So I do think there's a little bit more of a nail in the coffin in the sense that investors are looking at other options, and particularly international investors are looking at other options. So you may see flows out of the U.S. Because of these structural reasons, and the last downgrade might be the catalyst to get them to actually pull the trigger and move that money, but I don't think it's the cause of it per se. I think it's based on information that the market already knows.
So interesting. You laid out a few potential risks there, right? With the flow of money from the U.S. to international markets, earnings revisions. Is there an underestimated risk in your view at this point?
I think the single biggest underestimated risk is negative estimate revisions due to some combination of tariffs and changes in immigration, right? So if you think very simplistically, GDP is equal to labor force times productivity. And if we start deporting people in the context of a pretty tight labor market, then that can cause inflation to go up, and it can also cause GDP to go down. So if immigration policy materially changes, I think that's an underappreciated risk because that will impact corporate earnings. Companies will have to pay more for workers, and that's going to hurt their margins, leading to negative earnings estimate revision. So I think that's the biggest underestimated risk. I think the tariffs were an underestimated risk, and then they were an overestimated risk when the market was acting as though the April 2nd announcement would be implemented literally, which it's clear now that it won't be implemented literally. So that's less of a risk, but I do think the labor market is the single most important element holding up the U.S. economy and the markets. And if the labor market weakens because of immigration or any other reason, then that's the biggest risk.
Yeah, we've been hearing that from quite a few strategists at this point. You also say that valuations remain a risk. And heading into 2025, stocks were already stretched. So how concerned should investors be when it comes to stretched valuations at this point in the cycle? And are there pockets of opportunities out there that are maybe attractive right now?
Great question. So we started this year after two back-to-back years of over 25% S&P returns, with S&P valuations 2 standard deviations above the 30-year median. That's pretty high. Of course, we had that big swoon in March and April, and it bottomed at just over the median, so about average valuations. But now we've recouped almost all of that, and so we're back up above 1 standard deviation more expensive, so that is a risk. However, as there's the famous quote that markets can stay irrational longer than you can stay solvent, valuations can remain high. Valuation alone is never a catalyst, or rarely a catalyst. Valuation alone just tells you the downside if there's a negative catalyst that causes valuations to decline. It tells you where they can go, but valuations alone are not likely to do that. But you do have international stocks trading at much cheaper valuations. They're not expensive relative to the US. And now that we've seen geopolitical uncertainty, tariff uncertainty, economic uncertainty, and deglobalization, you may very well see more money continue to flow out of the US into international stocks.
All right, Ellen, some great insight there. Thanks so much. Appreciate your time.
Thank you.